Welcome to this crossover episode of the Consumer Finance Podcast and Payments Pros. I'm Taylor Gess, an associate in Troutman Pepper Locke's Consumer Financial Services Regulatory Practice, and I'll be your guest host for today's episode. Today, we're giving you another installment of our special highlight series on point-of-sale finance, where we are joined by colleagues from our corporate team to highlight recent trends related to bank charters, bank M&A, and bank partnerships. But before we jump into that topic, let me remind you to visit and subscribe to our blogs, troutmanfinancialservices.com and consumerfinancialserviceslawmonitor.com. And don't forget about all of our other podcasts. We have the FCRA Focus, all about credit reporting, the Crypto Exchange, about crypto and digital assets, and Moving the Metal, our auto finance podcast. All of those are available on all popular podcast platforms. Speaking of those platforms, if you like this podcast, please let us know. Leave us a review on your podcast platform of choice and tell us how we're doing. Now, as I said, today's episode is another in our special highlight series on point-of-sale finance. Here I'm joined by my colleagues James Stevens and Sarah Hanna to discuss what is happening in the transactional world with bank charters, bank M&A, and bank partnerships. James and Sarah, welcome to the podcast.
Thank you. Great to be with you.
Thank you for having us.
So James, I know we're all fielding a lot of questions from payment and fintech companies related to pursuing a bank charter. What do you think is driving that interest in bank charters, and what types of companies are most actively exploring charters right now?
Well, Taylor, I think the biggest driver right now is that people see a once-in-a-lifetime opportunity to potentially get a charter approved, and they think that they have to take advantage of that opportunity. Over the past, say, 10 or 15 years, it's been very difficult to get through the regulatory process for anyone other than your most traditional kind of community bank, de novo bank applicant. So if you're in the crypto space, or if you're a fintech company doing lending or some kind of deposit or payments, very difficult to get through that regulatory process. The current administration has changed that dramatically. The tone from the top has certainly been, we are open for business at all the federal banking agencies. And the OCC in particular has been encouraging people to come inside the regulatory perimeter and file de novo applications. And so it's driven a tremendous spike, certainly in the OCC National Bank charter, but also we're seeing a spike in state bank charters. And it's actually flowing over to traditional bank applicants as well, just as they're seeing all this activity. Anybody that needed to come out of the woodwork to form a bank is coming at this point. And then we're also seeing a tremendous spike in what I guess I would call specialty bank charters, like the OCC's National Trust Bank and various state uninsured banks.
James, thanks so much. That's really great background to help understand the motivators and considerations with respect to bank charters. So James and Sarah, are you also seeing an uptick in bank partnerships, and how is the regulatory environment driving that increase?
We certainly are seeing an uptick in the bank partnership space as well. Really, I think across the entire spectrum. Sarah, what all have we been seeing in terms of different types of partnerships?
We've been seeing an uptick in partnerships generally. We've been seeing a lot of lending as a service. While I think the regulatory environment has cooled off a little bit, we saw quite a spat of regulatory enforcement actions and state interest in these partnerships. Where I think we've landed is that those enforcement actions and that regulatory interest has given us a model for how to do it correctly. And that has garnered a lot of interest in the point of sale finance kind of community and lending community generally.
Sarah, I'll tell you, one of the things we've been talking about is that the enforcement actions seem a little different too. I think that we had this big spike between 2022 and 2024 where companies that were in that space were kind of getting the book thrown at them. I feel like they're a little bit lighter now. What do you think, Sarah?
I would say that the focus has certainly shifted. A couple of years ago, you saw a huge focus on onboarding, third-party compliance, vendor management, that sort of thing. And I think the focus has really shifted away from that and more toward kind of BSA compliance and kind of higher level scrutiny of these programs.
Thank you both. So now that we have a better understanding of what is happening in the regulatory environment with respect to both charters and bank partnerships, I think there's another option we should discuss. James, are some of these players looking to buy banks instead of chartering new ones? And, I have to ask, is buying a bank easier or quicker than chartering?
Absolutely. The uptick in charters has also been mirrored with an uptick in change of control transactions where non-banks are trying to buy typically a smaller bank and then convert the business plan, maybe eliminate offices or certainly change locations. Those transactions are really not easier from a regulatory standpoint. The statutory factors are slightly different, but essentially the regulators are going to underwrite fully the business plan, management, financials, and the risk and compliance management framework, whether it's a de novo or buying a charter. I think the real benefit is almost in the cost. It just takes a really long time to start from scratch and create a new bank. I mean, there's benefits to that. You're starting, everything's new. You can design it exactly what you want. You don't take on legacy management, legacy systems, et cetera. But if you find a charter that has good people or good systems in place, or preferably somebody that's already in the space that you want to be in to some extent, you can acquire that bank and you start off day one with some footings in place. It can be financially much more attractive. It can also go quicker to do a bank charter acquisition, but it really requires that you have a bank in mind and that deal can quickly get put together. What we see a lot of times is that people want to go down that route and they may spend 6 to 12 months looking for a charter and they don't ever find it. Whereas if they would have gone a de novo route, they probably could have been open in 12 months. So if you can find one and you can get it going really quickly, you might be able to cut that time into half or even less than 6 months with a change of control transaction.
James, thank you for that. And Sarah, as we start to wrap things up, I think our listeners will really want to know, if a point of sale finance company came to you today and said, we want more control over our funding and product, would your advice be to charter, acquire, or partner?
Taylor, like with anything, I think the answer is that it depends. To James's point, partnering with an existing bank is likely the quickest way to get to market if that's ultimately your goal. Partnering with an established bank can also help you because they have the framework and compliance network in place to help get to market. If you're interested in getting to market a little bit faster, then acquiring an existing bank charter can help you do that. But again, you're onboarding a lot of their existing systems, management, and just their procedural history. Chartering would give you the most flexibility because you're essentially starting from scratch. But along with that comes higher capital needs, a much longer time frame. Whether or not a point of sale finance company decides to partner with an existing bank, acquire an existing bank charter, or do a de novo bank charter ultimately depends on factors like their timeline, their capital needs, what their management team looks like, and their regulatory risk appetite.
I think that's right, Sarah. A bank charter is not for everyone. I say that it's been hard, but really that hasn't been tested too much. Historically, a lot of people have decided, hey, I'm in the point of sale finance business. I'm really good at designing user interfaces, customer onboarding, but let's leave the regulatory stuff to the banks. And I don't necessarily want to be a bank. So it really just depends on the facts and circumstances and what you're trying to do. And I think this is a great place to make this observation, which is not all the people that are getting conditionally approved to form banks are going to open as banks. I think that historically, the standard of getting a conditional approval was much more rigorous. And there seems to be a lower standard that's being applied now to give quick conditional approvals to these applicants. And so I believe that, we will see a dramatically lower percentage of these banks actually pull through. And I think that when you start to see that and when people start to observe that happening, it might chill the chartering path a little bit. But that should have no impact on the partnership space, except perhaps enhance it and make people run towards it more. So there's really no right answer. It depends on your facts and circumstances. Like Sarah said, your management, your ability to be a regulated entity, how quick you want to get to market, what you're trying to do. Are you just trying to get one thing, like the ability to originate a loan, or are you trying to get funding, which would be help if you wanted deposits? It's a very complex set of circumstances for people to consider. And it's just great, frankly, that we have the opportunity right now for people to seriously consider whether buying or chartering is reasonable for them.
And practically speaking, what should a point of sale finance company be doing now to prepare for one of those paths that we just talked about? And how would that answer change if you're legal counsel?
Regardless of the path that a company chooses to go down, I think it's helpful to start considering the regulatory and compliance requirements early on and start, if possible, getting into conversations and informal discussions with the potential regulators to start teeing up whichever path that they choose. Another thing to consider when you're a point of sale finance company would be to start building your internal compliance infrastructure now. I think that's one of the things that takes a lot longer for companies to get in place. When they go down one of these paths, I think they're more focused on the contracts, talking to regulators and getting that in place. And then it's the actual operational components of it that may delay a launch. And so start building that compliance infrastructure now, not later. One thing that I would also recommend is to get in touch with legal counsel, and preferably regulatory legal counsel, and start talking to them about the different paths, whether to partner with an existing bank, acquire an existing charter, or charter a new bank.
I would contact Troutman regulatory counsel, not just any regulatory counsel. But I think Sarah's spot on. The readiness to be a regulated bank, or the readiness to be in a contract with a regulated bank where a lot of that regulation is passed down to you by contract, that's really what takes a while. And no matter which route you're going to go, there's a lot of wood to chop there. And so getting prepared for either path takes exactly what Sarah just said.
Yeah, I think that makes a lot of sense. And the compliance attorney in me loves the nod to keeping the operational compliance at the top of mind. And James, as you said, that's one of the things we do great here is blending that transactional world with the regulatory and compliance world. Thank you, James and Sarah, for being on the podcast today and updating the audience on what we are seeing in the banking space. We're going to leave the special point of sale finance series here for now. We'll pick back up with another very interesting topic on our next special episode of the Consumer Finance Podcast. In the meantime, thanks to our audience for listening today, and don't forget to visit and subscribe to our blogs, troutmanfinancialservices.com and consumerfinancialserviceslawmonitor.com. While you're at it, why not visit us on the web at troutman.com and add yourself to our Consumer Financial Services email list. That way we can send you copies of the alerts and advisories that we send out, as well as invitations to our industry-only webinars that we put on from time to time. And of course, stay tuned for a great new episode of this podcast every Thursday afternoon, and look forward to the remainder of our special highlight series on point of sale finance coming soon to your podcast feed. Thank you all for listening.
Copyright Troutman Pepper Locke, LLP. These recorded materials are designed for educational purposes only. This podcast is not legal advice and does not create an attorney-client relationship. The views and opinions expressed in this podcast are solely those of the individual participants. Troutman does not make any representations or warranties, expressed or implied, regarding the contents of this podcast. Information on previous case results does not guarantee a similar future result. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission of Troutman Pepper Locke. If you have any questions, please contact us at troutman.com.